think we should probably go ahead and start. So welcome everyone to the third in our series of the Amplify educational webinars. And today we're going to be talking about sustainable investing and specifically green returns and how you can invest your money confidently for the future. And this is going to be focusing on pensions, but there also might be a little bit of conversation at the end about other things that you can do too. My name is Christina. I'm the coordinator for the Amplify educational program. I'm an impact advisor and B Corp consultant, and I'm going to be your host for today's webinar. And we are hosted by Amplify, which is a business community focused on sustainability. And before we proceed with the topic of today's webinar, I'd love to invite Jen Kitchen, co-founder of Amplify, to tell you a bit more about the organisation. So Jen, lovely to meet you.
Thanks, Christina. So we started Amplify about 2 years ago now, and the whole premise of the organisation is very simple: to help businesses to reduce their carbon emissions. And what that looks like is on various different work streams. So we have things like film screenings, an educational program like this one. We have a whole ton of different resources and topic-specific individuals that can help the businesses that we work with. We also have carbon literacy training, and we have a number of other kind of initiatives to really help businesses to reduce their emissions. And our whole premise is that it can cost money. So our goal is to raise money from different areas, from the council, from local employers, from the Tunbridge Wells BID, Business Improvement District. So we can help businesses as cost effective as possible. A lot of the times, everything is free to the businesses that we work with, which obviously reduces that friction. We try and make it as simple as possible, and we try and look at all sorts of different aspects. For instance, we've got some waste consultants at the moment going into some of our businesses, looking through their waste and figuring out ways that they can look at their supply chain and make better decisions for the environment, but also for their profit, for their margins. Because a lot of decisions that you can make in this area are not only good for the environment, but they can also be good for the bottom line. So that is our whole goal as part of Amplify, and I'm so thankful to yourself, Christina, for putting on this part of our work stream.
Very welcome, Jen. It's a pleasure. I'd also just like to mention that we have Toby on the call as well. He's going to be doing our tech in the background, and we'll be doing a little poll in a minute. Yeah, thank you, Toby, also for your time. And let's get on with the webinar. So thanks, Jen, for Amplify introduction. One thing we really want to do with these webinars is start to kind of get businesses thinking about the different ways that they can engage with sustainability, both from a business perspective, but also on a personal perspective as well. And so today's topic is about pensions, and obviously we all, hopefully most of us, have our own pensions, but also if you're a business owner or have as a senior in your business, you will have a responsibility to your employees as well. And so I'm really pleased to invite or to introduce Chris Bush, who is a senior financial advisor at Hall and Gertski Wealth Management, and he is a chartered financial planner and investor, and has been involved in financial services for 20 years. So we're really looking forward to him being able to being here to share his experience of managing a team of advisors, advising and building long-term relationships with clients, of which some of that experience he's going to share with us today. Outside of work, he's also planning to run the Brighton Marathon next year, so that's now being recorded publicly. So we can watch the space on how you do with that, Chris, and you can tell us a little bit more about that later. But Chris is going to tell us a bit about the world of pensions, help us understand what we can do with our own pension pots, as well as guiding others in organisations to take more control of their own pots as well, and looking at that from both a perspective of impact as well as growth. Chris has got some great information all about how we can understand a bit more about what sustainable is in a fund, and hopefully by the end of the session we should have a better understanding of the steps to take more control of our pensions, and also get a bit more confidence in looking at how we choose more responsible investing and exploring how we plan for our own retirements. So before I hand over to Chris, I'd just like to pop up a quick poll to give us a sense of where we all are on this subject. And so the first question we have is just to get a bit of a baseline understanding. Do you know, and Toby, if you could pop up that poll, that would be great. Do you know how to find out how much is in your total pension pot today? So if you could just answer that question, that would be great to know. And let's see what the results are. And hopefully if Chris is answering this question, it should be yes. How are we doing? Oh, so we've got some very brilliant. That's a good start. We're starting from a good baseline of we know mostly know about our pensions, which is great. And then the second question, Toby, if you could pop that up. So do you know how to find out where your pension pot is invested? And we'll be talking a little bit more about that today as well. So yeah, there's a little bit more of a balance here. We've got 43% saying yes, 57% are unsure. So that's going to be what we're going to be looking at today in terms of how you can kind of get a bit more into detail of what you do, who you talk to, and how we can move forwards with our pensions. So without more ado, I'd love to hand over to Chris. Welcome, Chris. Thank you so much for your time. Really looking forward to hearing a little bit more about what you do. If you could tell us a little bit, and then let's get into our webinar.
Brilliant, thanks. Yeah, good morning, everybody. And thank you for taking the time this morning to have a look at all things pensions and how where it's invested can have a significant impact on the environment. And thank you to Christina for the introduction. Just to add a bit more meat on the bones on that, yes, I have been working all my working life in financial services, and I've got over 20 years of experience. That chartered qualification, it's something that only 12% of the industry hold. This means if you want me to get technical, I can do, but in my experience, people very rarely do. In fact, they tend to glaze over if ever I try. So I feel it's best to try and keep things simple, which is what I'm going to attempt to do for you this morning. So the world of investing sustainably has changed drastically over the last 10 years, and now it's a real area of growth. And part of this is down to the fact that human beings are essentially quite selfish creatures, and the vast majority of us, except for the people on this call, obviously, don't want to change their behaviours for the greater good. This isn't a criticism, it's an observation. But it has meant that companies both innovating and changing practices are a key driver to this change. And actually, looking at how we invest, and specifically with our pensions, can have a significant impact and be a force for good. So I live in Brighton with my long-suffering wife, Mel, and our two children, Eddie and Grace. And they're part of the reason why I'm so passionate about this area. But I also think it's just the right thing to do. There will be time for some questions at the end, I think. I'm a big believer in the idea that there's no such thing as a stupid question other than the one that doesn't get asked. So if you do have any questions, please be brave and fire away at the end, or pop them in the chat. But hopefully, as we go through, I will be answering some of the questions that you have, so they'll just get answered organically for you. So and get on to the next slide. Is that slide changed for everyone?
No, not yet.
Sorry, let me just, sorry, I'm going to reshare that and start that again. Try that.
And just so everyone knows, we are recording this, and as usual, we'll be sharing the recording on YouTube afterwards and on the Amplifi website as well, if you want to visit it later.
There you go. I failed on the technicals on the first hurdle. Right. So now I might be aware that there's some different knowledge on this call, but I thought it might be a good idea to explain exactly what a pension is, why they're so important to all of us. They are still misunderstood. And I've heard some people say, I don't like pensions. I must admit this confuses me, because they really are a fantastic investment vehicle. And essentially, they're what will power your lifestyle in retirement. You can pay into your pension each month and gain tax relief on your contributions, or you can make a one-off lump sum contribution and still get that tax relief. But the idea is that you build up a pot of money that will allow you to enjoy your retirement. If you're employed, it's likely that you will have an employer pension. If you are self-employed or a company director, it's likely that you will also have a pension, but it might either be a personal pension or a company pension that you manage yourself along this line. So, sorry, bear with me. As you pay money into your pensions, you will be able to claim tax relief on your contributions, as I've said. And they also grow free of any income tax or capital gains. But what does that mean? It means that if you're a basic rate taxpayer, you get a 20% uplift on your contributions on the day that you make the investment. And this is backed by the government. Now, I'm not aware of any investment that can give you a guaranteed rate of return on 20% day one. But that's exactly what a pension will do for you. If you're a higher rate taxpayer, you can claim back an additional 20% in tax relief. And if you're a limited company, you can make these contributions and not pay corporation tax. So in terms of reliefs, it really is one of the best investments out there. The government doesn't give us that much in terms of tax reliefs, but what they do give us, we really should be using. So why should you do this? So investing in a pension is really important, but you might say, well, look, I get the state pension. Sorry, I've gone on to the slide. We get the state pension. I'm going to be okay. Now, the state pension will pay you £11,973 a year, and you won't get it until you're age 67. So I've got two questions. Could you survive on £230 a week? And do you really want to carry on working until you're 67? The answer is no. Then you need to start saving into a pension. And it really is a fantastic way to allow you to do this. And people often say to me, how much should I be paying into my pension? And the simple answer is really as much as you can afford. But a good place to start is around 10% of what you earn. I talked in the previous slide about tax relief, and you might be thinking, what on earth does that actually mean? This slide shows that, look, if you were a basic rate taxpayer and pay £1,000 into a pension, then £1,250 will be invested. The government is giving you £250 day one. And I'm not aware of any investment that delivers that level of guaranteed return, which is why people like me bang on about the importance of pensions. So why should you invest sustainably, and what difference can I possibly make? That is a fair question, and I'm sure some of you might feel like this. Now, currently, there is 2,250 billion. Now, I tried to write that number down, but I ran out of space. That's just in UK pension funds alone. This money is invested in companies globally. In years gone by, exclusion was the way that ethical investing worked. This means that you just wouldn't invest in certain companies. In recent years, this has changed to engagement, and we are seeing pension funds working with companies to show them how they can change their practices work sustainably, and also make a profit. Global warming is a real thing, and it will take companies to innovate new products and change practices to help solve it. So this is an area that has huge growth for both companies and investors, because if these companies don't change their behaviours, then money will no longer be invested. But engagement first has made some real breakthroughs. Money talks, and in addition to this engagement piece, if you're also choosing to invest in companies that are innovating in areas like cleaning up our seas, businesses like Beyond Meat, then this extra investment will only increase the chances of these companies' success, bringing their product to the wider market and having an impact on our environment. It's estimated if you change where you invest your money, this will have 27 times the impact of things like, stopping flying, changing farming methods, using electric cars. So the impact is significant. There's also a financial motivation, as over the last 3 years, the global ESG index has grown by 18.9%. In years gone by, investing sustainably would have meant that you were probably seeing lower levels of growth, but also taking a higher degree of risk. This is no longer the case. And not only can you invest sustainably, but you can also generate strong investment returns. And going back to the point I made earlier, look, the larger your pension pot, the more money you will have in retirement, and investment growth will have a significant impact on this for you.
And Chris, can I just ask a quick question about kind of investing sustainably? And I know you're going to talk about the businesses that aren't at the moment, but are there enough businesses, sustainable businesses in the world for us to all invest in?
Yeah, 100%. It's a really good question. It is, gosh, so look, full disclosure here, I will talk about the funds that I advise on, but there are other, disclaimer, there are other funds out there that I'm sure work exactly the same. But our Sustainable and Responsible Fund actually invests your money across 150 different companies, and that's just one particular fund. So there are a number of companies out there that are doing this, and it is growing all of the time. I think, to my point I tried to make about the companies that are innovating, we are seeing more and more of these, because the environment is all of our problems, right? So if a company can crack that, there is also a fight. Not only are you doing the right thing, but there is a financial incentive for that as well. So it is an area that we're seeing huge amount of growth. To your point, I was tried to say, like, a few years ago, I think you were limited, which is why the risk was much higher, because you were only invested in a finite number of companies. But we have seen huge growth over that, certainly over the last 10 years, and I expect that to exponentially go again over the next 10. Is that all right? Does that answer the question?
Yeah, I think so. Yeah, thank you.
Okay, no problem. Right then, the offenders. So it shouldn't come as a huge surprise that the biggest contributors to CO2 emissions are oil and gas companies. But also, if you look at the top 5 agricultural food companies, as a collective, they emit more than Mobil, BP or Shell individually. Now, I can promise you, if you just hold a standard portfolio within your pension, you will be invested in these companies. And as such, it kind of guilts you contributing to the problem. If these companies start to see that their business practices won't be tolerated and it affects their bottom line, this will change their behaviours. You might have heard about rebel shareholders. These are people or institutions that will buy into a company with a specific target of going to shareholder meetings and forcing them to make a change. I won't name names here for fear of legal repercussions, but Google might help if you wanted to search it. But there are examples of financial institutions changing where they'll lend money and businesses they'll support, and also supermarkets of changing their method of packaging. Most companies are actually driven by their bottom line. And if they start to see that people will not invest with them then they will change their behaviours. This doesn't mean that you have to go to war with these companies. I've said it a couple of times. Engagement can be more powerful than threats. Institutional investors will often work with these companies to show how they can change their practices and have a positive impact. And you can use your money as an instrument of change, but it is up to you. To try and give you an example of this, over the next 2 years, Shell have actually committed to invest £15 billion into renewable energy. Some of this will have come around engagement and then realising that it's just good business sense, that their old business model will simply not make money going forward. Now, in no means am I suggesting that Shell are a bastion for the environment, but if your money can have the effect of getting these major institutions to change their behaviours, imagine the impact that this could have.
Chris, just to add as well, you know, we were a couple of webinars back, we were talking about digital sustainability, and I'm sure you'll tell us a little bit more about this, but I know you can go into your pension and actually see the holdings you have and see where you are. And I think a lot of us have tech investments in our pensions as well, and that's just something to be aware of. Like you say, you know, that's a big growth area, but also there's an impact there from a tech perspective in terms of CO2 emissions.
Yeah, 100%. Sorry, I lost my train of thought. So this slide, I mean, I really like this slide. So the UN have introduced these 6 principles for responsible investing, and the reason I like it because it's not overly complicated. But if you read through them, they also just make sense. And what we're starting to see more and more of are pension funds signing up to these principles, which means they are challenging companies and that they invest their money in to actually change their behaviours. The other reason I like this slide deck is that you can use this to build your own principles for investing. And it's something that I try and do with the clients I work with. Now, look, we'll all have our red lines, and this is allowed to be different for each individual. But one of the things that you can take away from this session is to build your own set of principles and then build an investment portfolio that matches these. So once you've built your principles, what comes next? Well, you need to put them into practice. I don't want to overcomplicate this, but there are essentially a couple of ways that you can invest your money sustainably. The first is just using a sustainable fund. Okay, this is an off-the-shelf option, and it will deliver a sustainable investment portfolio for you that will operate within certain parameters. And for the majority of people, actually, this would be a suitable option. The fund managers have signed up to those UN principles for investing and will look to invest in companies that meet a number of set targets in a variety of areas. Again, remember, they'll try and engage with companies to get them to change their behaviours, but there will be some companies and sectors that they just won't invest in. Having built your own principles, it might be clear that you've got a number of red flags. So actually, you might not be comfortable with an off-the-shelf portfolio, and a more bespoke arrangement might be suitable for you. A bespoke or a discretionary fund service will allow you to, you work with a discretionary manager to pick an investment portfolio, and you will have actual control over the companies where you want to invest. You set clear guidelines and parameters as to where the manager can actually invest your money. So you control where and with whom your money is invested. There's no right or wrong here, and both options will deliver an environmentally friendly outcome. But there are a number of factors that might influence your decision. And cost, actually, you know, it will be one of these. As these discretionary services typically have higher charges because there is more involvement. It might actually, cost might actually be something that concerns you, but if it is, that's absolutely something that you need to be aware of. So how can you put all of this in place? I really do think it's important that you take advice. I am aware that you might be sat there thinking, well, I'm a financial advisor. He's bound to say that. But look, if you're ill, you speak to a doctor. If you've got a legal issue, you speak to a solicitor. If you've got a tax question, you speak to an accountant. So if you have a financial question, why would you not speak to a financial advisor? Now, after your house, your pension's your largest asset. So you should really make sure it's invested in the right area and it's taking a level of risk that you're comfortable with. So unbiased.co.uk have found that people who take advice on average are £48,000 better off over a 10-year period than those that don't. And that is not an insignificant amount of money. Unbiased is actually sort of a fantastic website to find a financial advisor that operates in your area. Now, my view is it's really important that you work with someone that you get on with. So interview like 2 or 3 people and go with the person that you gel with, because actually, hopefully that working relationship will become a personal and professional relationship as well, and you will work with that advisor for a number of years. There is a perception out there that taking advice is expensive. Look, it can be, but in the vast majority of cases, it really isn't, and generally you do get what you pay for. Now, normally having a conversation with someone will cost you absolutely nothing. I would ask any financial advisor that you are looking at potentially working with to be really clear about their charging structure, what you get from an ongoing advice point of view, and what sustainable options, investment options, that they have, so that you can build a platform for you. So I wanted to, for the end of the day, give you some takeaways that are actionable for you, things that you can do. And the first thing is to actually take action. I understand that life goes on, but if any of this has resonated with you in any way, then put it on your things to do list and try and make sure that you do something. Find out where your pension is and contact them to find out where it's invested. You should have pension statements from your existing pension company. This will have both a telephone number and a policy number on it. Contact them. They'll be able to tell you what you've got and where it's invested. If you're not sure, you don't have that documentation, speak to your employer and find out. If you've left jobs, you might also have pensions from previous employers, like with your existing pension. So you should have annual statements that have a policy number and a telephone number. If you don't have these details, then there are companies out there, I think to say Pension Bee, advisors, they can help you find all these old pension pots. And then what you can do is potentially bring them all together and invest them appropriately. I'd like to go back to my first point, as the most important thing that we can do is take action. And if we all do something, this really can have a significant impact on the world we're living in. So look, thank you ever so much for your time. I think we've got time for some questions. I can't promise that I'll have the answers, but if I can't answer it straight away, I will come back to you. Stop sharing my screen.
Thank you, Chris. Thanks. That's been really, really interesting. And I'm sure it's kind of started sparking some thoughts in people's heads. It has in mine. I have a couple of questions to ask you, but I thought I'd go to the group first and see if anyone has any questions that they want to either ask directly or pop into the chat. If not, I've got some around, as business owners, whether we're sole traders or have our own limited businesses, or if you're senior in your business, what can you do? So I'll just give an opportunity, first of all, to anyone in the group, if there's anything they'd like to ask. Hi, Jen.
Hi. So as an employer, so I employ 20 odd people. And one of the things that I've been a bit hesitant about is pushing them, sort of nudging them forcefully down the ESG sort of route when it comes to their pensions, because I'm not a financial advisor. And I would be potentially kind of reluctant to say this is what we do as an organization, because it's people's money. Yeah. And so we have given advice in the sense of these are the 2 options and you can contact your pension company yourself. but I'm not sure how many people have done that, and I haven't asked the question. So I guess my question to you is just, should I be more forceful about where the team are investing, and how do I get around that morally, I guess, if I'm advising them to do so, and maybe their pensions don't do as well. I know you said the last 3 years have been sort of almost 20%, but what if it doesn't? What if it changes?
Yeah, I mean, look, so it's a great question. I'm more of a carrot than a stick kind of person. So I do agree with what you've done. I think that is the right thing to do. And where I've seen it work in the past, actually, is have the default option is the sustainable investment package. That is the default option as to where your pension will be invested. But there are another option if you don't want to invest in that particular way. But they would have to opt out of it and opt into the other process. So I think that's quite a powerful way of doing it. To your point around investment performance, you can't influence that, actually. You know, that is outside of our control. What you can do, or what could happen for the client, if you make sure that the pensions, where people's money is invested, works to their chosen level of risk, so they understand the level of risk that they're taking, and they've got a clear view of their need to take a risk and their capacity to take a risk. Actually, the day-to-day performance, it's not irrelevant, because no one likes it when it goes down. They love it when it goes up. But actually, bear in mind, you're investing for your retirement, and that could be, well, it's minimum of 57 or 55 at the moment. It's moving to 57. So there is a time frame option to it as well. And other things that I'm going to say we do it, but I'm sure that I'm not the only financial advisor out there. But whoever is looking after your pensions for your business, get them to come in and run a financial education workshop with your employees, and do it specifically about the pension fund that they are invested in. Knowledge is power, ultimately. And I think that way round, you're not pushing anything on anyone. You're giving them the knowledge and the understanding of where their money is invested, but they also have the option to opt out if they want to. Is that all right? Does that answer the question?
Yeah, that's absolutely brilliant. Thank you. You've given me some really clear actions.
Thanks.
And we were actually talking about this earlier, weren't we, Chris? Is that everyone who has a pension has been opted into something. So, choosing what you're opted into is usually done by the pension provider. So if any company takes a little bit more of a role of guidance and kind of links that to those values that Chris was talking about earlier, that can be quite powerful. And again, we're talking about where the money goes and how much influence we can have as businesses. Lots of businesses say, what can I do as a business to do more from a sustainability perspective? This is a great way of having quite a bit of impact that we, like you say, Chris, is fairly straightforward compared to, say, car sharing or all sorts of other things we talk about first when we talk about sustainability in a business. And Chris, to elaborate on Jen's question, we were talking earlier about, you were saying helping businesses to kind of build a sustainable pension policy or start to think about how they implement that. Have you got any more suggestions or guidance on what businesses could do to kind of start off on that journey?
So, look, again, I am a financial advisor. I would say speak to a financial advisor to help you on that, because what they could do is they could find out what your base level is and build a plan that's appropriate around that, because it's interesting, isn't it? Sustainability can mean different things to different people. So it is about building a plan that will work for you and your business. And sometimes, because there's so much information and choice out there, if you don't know what you're doing, it can be overwhelming, and then you start wondering whether or not am I making the right decisions, am I doing the right thing? And the danger is then you just don't do anything because you just it's just too much to take on. But working with an advisor, so to your point earlier, Christina, about how do I know when my funds are being invested? So you might be able to get a fund fact sheet, for instance, that will give you the top 10 companies. An advisor will be able to get you this is the list of all the companies that this particular fund is invested in. And it might be that there's some stuff in that you do not want to be invested in, but you don't know that you are physically invested in it. So yeah, I am aware that I'm not just go and talk to an advisor, but that I think that's the baseline, and then you move it on from there.
Stephen, got a question?
Hello. With these sustainable funds, to what extent is it sort of investments into the obvious kind of green companies like renewable energy companies and startups in that kind of area? And to what extent is it actually investing in established sort of big companies, but who are doing things slightly better than the other big companies? So they're still going to have a carbon footprint, but they're doing it slightly better.
It's a really good question. We're seeing more of those smaller companies coming into these funds, and there are, I mean, some of the names of these investment funds, where they get them from is beyond me, but you might have so one for each, like Small Futures Company, that would be a fund that would not necessarily invest in the FTSE one, or the larger companies that are just trying to do things the right way. They will be investing in these smaller, almost startup type companies. I think the thing to bear in mind with that is because they're smaller companies, the risk tends to ratchet up. So it is about building something that works to a risk level that you're going to be comfortable with.
Yeah.
But you could have an element of that as part of your portfolio, and an element in something else. The direction of travel is towards those types of companies that you're talking about, but until they get a bit more established, it's also about managing the risk that a client is prepared to take.
Yeah.
Is that all right?
Yeah, I mean, we're in a similar position to Jen, but with the pension pot is probably slightly bigger because there's sort of 450 employees or something like that. I'm on a pension committee, but also the Green Committee. So it is really sort of scary idea to switch the default fund, because it's sort of 4 or 5 people making a decision for the entire company. And I know that in theory, it's not because they can opt out and go and pick another one, but the evidence is that basically nobody does anything except leave it as it is. Yeah. So in that way, great, we can make a positive impact straight away in terms of that type of thing. But I think sort of angle of my question was that actually, if we could go and say that actually it's not that we're ramping up volatility and risk by doing this necessarily, because it's not all in renewable startups, it's actually also in all these other companies that you recognize, but they're the good ones and we're taking out the bad ones.
Yeah, and so for something like that, I would absolutely engage with an advice firm and get, you'd want their investment committee to come down and be breaking down, right, these are the funds, these are the options, this is what it, so you've got number one, as the pension committee, you've got a real clear line of sight of how it all operates. With that size of pension, you could have a low, medium, high. I'm just going to go really simple, but you might have different risk profiles that people could badge themselves into as well. But yeah, that engagement piece with the investment firm to build something for you, or your company, sorry, that would absolutely be the way to go with that. But yeah, 10 years ago, if you were investing ethically, you were taking more risk. Full stop, the end. It's not like that anymore.
Okay, interesting. Thank you.
Kelly, have a question.
Yeah, I know that we sort of, like you're saying that there is no risk, but there's still this. So my business partner is a real stickler for just sticking with the same and no risk. So when we did our pensions with our advisor, you go through this sort of questionnaire and it sort of works out from the answers that you do if you're high, low or medium risk. He was sort of super safe and I was way more risk, which is probably why we make good business partners.
That's why the business works.
So I'm ethically as well, and looking at it, we've sort of performed fairly similarly. Like I'm more up and down, he's more steady, but his isn't so ethical. But he just says, "Oh, well, that's because you're on the higher one. If I move to an ethical one, it's there'll be more risk." I need to convince him that that is the right thing to do.
If his level of risk is that he doesn't want to leave the house for fear of getting run over in the morning, then actually it's comparatively speaking, it might be it's because any investment, if you are going to go into shares or equities, for instance, you are taking a level of risk. But there are also, there are now ESG corporate bonds, there are ESG government bonds, but the devil is in the detail with that kind of stuff, because you've then got to start looking at, actually, just because it's got that badge on the front page, what sits behind it, and am I comfortable with that?
I think I was gonna go on looking at exactly where they're invested, because we've got all that information if we go on our apps and things like that. And then I'll go, right, I'm going to start picking at him. Would you know that they do this? And do you know that they do that?
Yeah.
And is that what he's got 2 kids and he now lives in Norway, so they're very...
And it might be that he says, no, I'm comfortable with that. But if he actually knew where it was and where it was, that might start... I'm not sat here on this call suggesting that all of a sudden we need to change everyone's risk profile and make them start taking risks they're not comfortable with. It is about having that balance, for want of a better word. But he could also do some, right? So if he's got no money invested responsibly at the moment, all right, keep 50% of it in your lower risk stuff that you're comfortable with, and move some into a social response. Yes, that element is taking a bit more risk, but your overall risk profile remains the same. Does that make sense?
Yeah.
Because 20% of it is better than 9% of it.
Okay, thank you.
No worries.
Thank you. And Chris, we're talking about businesses here, and one of the questions we had when everyone signed up was around what else can you do? So we've had previous webinars, we've talked about communities and getting engaged locally, and having an impact on social value. What can businesses do beyond their sustainable pensions policy in terms of kind of having ethical investing impacts, either in the local community or in general through what they do with the money that they have?
Yeah, okay. So I think on a local level, it'd be difficult to invest your pension money in something, because within a pension, it's got to be a listed company to qualify. But there might be projects in your local area that you want to support, get behind, or anything like that. What I'd probably say, that because it's smaller, it does tend to be riskier. So if you are putting your own money into something like that, do an amount that you can afford to lose. I don't want to get into the sort of delves of advice, but that's generally the rule of thumb with something tends to become a bit riskier. But actually, so I don't want to talk about my charity work, but I sit on our national foundation, which is our charitable foundation. And on a local level, what these types of things tend to need more of is actually your time and your expertise. And that can have more of a significant impact than the money you might be able to give them. So if as a business, you wanted to support, you saw a local cause that you wanted to get behind, I don't know what your businesses are, but you probably will have a skill set that cause needs. And if you could give up your time, that actually might be more valuable than any financial gift that you might be able to give. That's just what I've seen, actually, personally.
Interesting. And I know quite a few businesses on here are B Corps, and there's an element of that certification that requires you to, or if you want to, you can design your business to give back, and that can be either financially or through your time and expertise. So it kind of aligns with what you're saying. And there are organizations you can sign up to, like 1% for the Planet, or you can pledge 20% of your profits or 5% of revenue, for example, and make those public and kind of sign up to those. Something I also heard about recently, and I was kind of mentioning it to you earlier, is around credits. And people quite often kind of assume credits are offsetting, but you can actually just buy into credits. So regenerative farming is quite a big one in the UK now, and you can kind of purchase those credits to help farmers to kind of regenerate certain parts of their land. There's also plastic credits and carbon credits, and it doesn't have to be as an offset process. It can also be through a way to invest into programs and projects that are kind of aiming to improve, say, peat land or forests or things like that. So I think there's an element of kind of switching the perspective of that kind of opportunity as well.
I can't profess to be an expert in those areas, but what I would say is we've started seeing them over the last sort of couple of years. My gut feel for the direction of travel is that you're going to see more and more of these opportunities become available, and it will have an impact. You know, absolutely will do. Like I've said it, I think I said it in the presentation. Money talks, and you can either choose for it to be a power for good or not, basically.
Yeah, absolutely. Do we have any other questions, burning questions at the moment? I'm sure there are in terms of details. I know for me personally, oh, sorry, Jen, you were going to ask a question.
I was just going to ask Chris, just in your experience, I know sort of the percentages that businesses pay into pensions has kind of steadily increased from sort of 1%, 2%, 3%. What's the sort of average that you see from a business paying in to a pension for the employer?
Yes, it's a really, really good question. So the Nest scheme basically says that the employer pays in 5%, the employee pays in 3%. So that's like your base level, if you like. Actually, as from an employer perspective, if you can afford to pay more into your employee's pension, there's a tax benefit for you to do it. But also, it's an added benefit for your employees, that they are getting more from you. So there's a reason in terms of sort of staff retention. It helps with that, makes you more competitive against your peers. So I guess on average, I would say somewhere between that 5 and 10% mark from an employer point of view. Something else that is really valuable that some employers do and others don't is allow their employees to do something called salary sacrifice. So how that works is you give the employee an opportunity to pay more money into their pension directly from their pay. And the advantage for the employee, so that tax relief I was talking about, that's income tax. So the money goes in before they pay income tax, also goes in before they pay national insurance. So for a basic rate taxpayer, actually that's essentially a 32.5% gain, and obviously that ratchets up if you're a higher rate or an additional rate taxpayer. So giving your employees opportunities, if they want to salary sacrifice, is another way of doing it, rather than all of the onus being on you as the employer.
Perfect. Thank you, Chris. That's great.
No worries.
If I was going to be looking at the details of our pensions and seeing which exactly where they're invested, how do I then check that whatever they're called is ethical? Is there a sort of way of checking?
So yeah, it's a good question. So obviously what you wouldn't want to do is try and do the research on 150 different companies, because you never get any work done, would you? You basically have to take 2 months off to research your pension company. So I would go back to whoever your advisor is, whoever set it up, and say, look, what are the parameters that this fund manager is working under in terms of the companies that they can invest in? To Stephen's point earlier, there are some funds out there that will just look at the smaller bespoke businesses, but there also might be some larger companies in there that just do things better than others and have been seen to change their direction of travel. I guess, look, if you're an enormous company, to totally change over, you're like a bloody great big ship, aren't you? So to change direction might take a bit of time. If the parameters are, look, we can see that you're committed to this, we've got a business plan that over the next 2, 3, 4, 5 years you're going to do this, we're happy to invest with you. You might not be comfortable with that, but if you know that they are the parameters, then that's how you could work with. So it would be, I would check with who set the pension up first and just say, right, these funds where I'm invested, it'd be good to get a handle of all the companies that it's invested in, but also what are the guidelines or the parameters that the fund manager has to stick to.
Okay. Fab. That was all for me.
No worries, thanks,
Thank you. Do we have any other questions? And otherwise, do we have any final points from you, Chris? I think we're good with questions for now.
Right. So yeah, look, I mean, I think that the first thing to say with this is it can seem daunting, right? And you don't eat an elephant in one sitting. Like, you don't have to change it all today. You don't actually. And if you did try and do that, one or two things would happen. It would either be too daunting and you think, oh God, I'm not doing this, or you take on too much and mistakes start happening. So my advice would be, is do something, make a change. If you've got a really good handle on where your pension is, you understand it, and you work with an advisor already, brilliant. You're taking advice. That's all I really want, actually. If you're not and you're a bit unsure, my other bit of guidance would be to steer you towards a financial advisor, because they can demystify all of this and build a financial plan that works for you. And ultimately, it's not just me saying this, there is the research that proves it, you will be made financially better off. So that would kind of be my last thing. And sorry, the last thing, sorry, I'm waffling now, is don't think that what you do won't have an impact, because if we all think like that, nothing will ever change. Actually, what you do does have an impact, because you, by doing it, will naturally encourage more people to do it, and it grows like a snowball going down a hill. It just builds momentum. So what you do personally can have a huge impact collectively.
Fantastic. Thank you, Chris. I hope that's inspired some of you to have a look at your pensions again. I think, Toby, if you could pop up that poll, and let's check and see if, let's do the second question, see if we've got a bit more of an idea of how we could find out where our pensions are invested now. See if any of us have changed that unsure to a yes. Give Chris some feedback.
It's gone down, I'm really in trouble, aren't I?
Yeah, exactly. Or maybe it's just more information that you didn't know before.
I've de-knowledged everyone.
But I think, oh, brilliant. We've got 100%. I think
Brilliant.
that's A star for you, Chris. Brilliant.
Yeah.
Thank you.
Yeah.
I found this really interesting. It's got me fired up to have another look at where my investments are. And also, I think along the lines of what you're saying is practice having an advisor, because at some point you're really going to need one. I think at the point where we all retire, I think is when most people, you've said, most people engage in an advisor, and that's almost too late. And if we can do it earlier, at least we practice having those conversations before it really, really matters. So yeah, pop along to Unbiased and see if you can find someone that you click with. And thank you everyone for your contribution and your really fantastic questions. They've all been really, really interesting. And we're going to pop this, as I mentioned before, we're going to pop this on YouTube after this call, and we'll share the recording link in an email afterwards, and I think we'll put a blog on the Amplifi website as well. So if you want to tell anyone else about this, and if they want to kind of learn a little bit more, please send them to that place. And if you'd like to stay in touch with any further events that we're doing, you can sign up to our mailing list at amplifi.tw. And Toby, I think we've got a few webinars coming up. Would you like to tell us a little bit more about what's coming next?
Yes, it'd be my pleasure. Hi everyone, just a quick note from me. We've got 2 great webinars coming up over the course of the summer. The first is on Wednesday, the 11th of June, with Tony Mayer, who is the procurement director at Cook, and he's going to be talking to us about how to meaningfully engage our supply chain, using a few of his examples as to how he's got around the sustainability issues around there. So I'll pop that link in the chat right now, and for all those who aren't on the webinar, it will be coming out in our Amplifi newsletters, so make sure you're all signed up at the bottom of our Amplifi website. And the second webinar that's coming up is on Wednesday, the 16th of July, with the amazing Michael Solomon-Williams from Campaign for Better Transport, who is going to be teaching us about his new business toolkit for encouraging sustainable and green travel, and the whole plethora of benefits that can bring to a company and its employees. So please do come along. It'd be great to see you there. And that's all from me for now.
Thanks, Toby. Thank you. So yeah, thank you everyone for all of your time. We look forward to seeing you on other webinars should you have the available time in your very busy schedules. And all I have left to say is thank you so much, Chris, for sharing your wealth of knowledge. If you want to ask him more questions, please do get in touch with him. Information is on the ticketing link that you signed up to, and also you can have a look on our next mail out. And thank you, Jen and Toby, for Amplifi support for running these webinars. And if anyone of you want to share Amplifi's impact and what you've learned today, please do, or get in touch with the team if there's anything else you'd like to get involved with regards to Amplifi. And without further ado, thank you very much. Have a lovely day. Enjoy the lovely sunny weather, and I hope to see you soon. Take care. Thank you.